In regards to mortgage loans, there's often confusion as to what's meant by term versus amortization. So amortization is the length of time it'll take to pay off the entirety of the mortgage loan. So at the end of your amortization, say if it was 25 years, you would have paid off the entirety of your mortgage loan and you would then own the property.
Amortization, it's really common to have 25-year amortization. Now this is for high ratio mortgages. That means you have less than 20% down. A 30-year amortization is still available in Canada, but only if you have 20% down payment or more available.
So if you have a longer amortization, say 30 years, your payments are going to be a little bit lower than if you have a 25-year amortization. However, with a 30-year amortization, you're going to end up paying quite a bit more in interest versus the 25-year amortization.
One of the best parts about going to a mortgage broker is that we can discuss different strategies with you based on your situation. So let's say you wanted to buy a rental property. What I would suggest is putting you into a longer amortization in order to reduce your payments. This is to ensure positive cash flow on your income property. But if your goal is to pay off your mortgage sooner, we will put you in a lower amortization, because 25-year amortization as opposed to 30 years, you're going to pay off your mortgage 5 years sooner.
So a term is how long you're under contract with a certain lender at a certain interest rate. There are two types of terms. There's closed terms and open terms. So closed terms are when you have a fixed interest rate for a fixed amount of time, and there are going to be severe payout penalties for ending your contract early. So if you had a 5-year term and you needed to get out of it in 3 years, you're looking at a refinance, and there's going to be serious penalties involved.
An open term is the exact opposite of a closed term. There are no payout penalties involved if you want to break your contract early. The trick is you're going to be paying much higher interest rates if you choose an open term as opposed to a closed term.
So that's the difference between amortization and term in regards to a mortgage. If you need any additional clarification or have any questions for us, please shoot us an email or give us a phone call, and we'll get back to you as soon as we can. So thank you for watching.